So let's get started here. Can you tell us a little bit how and why Wefunder came about? How did the whole
idea? Yeah, it's a great question. So my co-founders and I had all started companies prior to Wefunder and been through the fundraising process and ran into this accredited investor restriction, right? So we weren't allowed by law to invest in our friends' companies, and they couldn't invest in ours simply because we weren't wealthy. And we thought that was stupid, very un-American, and not at all what the country needs in terms of supporting entrepreneurship broadly. So back in 2012, we got together and, helped advocate for some adjustments to be made to something called the Crowdfunding Act, which was moving through Congress at the time, that would change all of this. So instead of having these wealth requirements around who could invest in startups, now everyone would be able to invest in companies they believed in, be it, friends and family or the users and customers that really help give, companies lifeblood in the first years of their existence. Those people should be allowed to, make investments and possibly make the returns that you're talking about when you reference, the Googles and Facebooks of the world, so on and so forth. So, Congress had been thinking about making this change, but didn't have the experience being in the weeds of either raising funds or kind of the internet and entrepreneurship itself that we did. So they left out some provisions and included some things that would have made the law very difficult to implement in reality. And so we launched a petition basically advocating for some very specific changes to be made to the legislation that would have allowed it to be actually a practical thing to implement. And wound up launching this petition, getting a ton of press and support for it, and really became the public voice for the startup community in DC, helping Congress understand exactly, what the things that would and would not work for the legislation they had originally proposed were. Helped them work through that over the course of the winter of 2012, and then we're in the Rose Garden for the bill signing ceremony, and watched the president kind of sign it into law with a stroke of his pen. So it was an exciting time for us.
Excellent. So you guys are really the instigator of that concept.
Yeah, there were a bunch of different people that were involved in helping kind of advise Congress at that point, but in terms of folks that actually went forward and launched a platform and really built a business around it, that's us.
It's a very new concept, right? When did it really start?
So May 16th, back in 2012, we helped write the law, but it was kind of in what's called a rulemaking period with the Securities and Exchange Commission for the past 4 years. So we finally got the full legislation implemented on May 16th. And so we've been in market allowing, everyone to invest in companies they love since May 16th.
So it's still very fresh, very new. Many people don't really completely understand what it's all about. So that's exactly what we want to do today in this video, is sort of demystify the concept. So first things first, can you explain how does Wefunder works? Who's on it? What happens on it? Who are the typical investors, the scouts? I took some of the names that you have on your site. The scouts, the referrers, the WeFund, the sponsors, the clubs, the process, etc. In a nutshell, can you help us understand a bit more, where do we start as an entrepreneur?
Yeah, it's a great question. So I think that the best way to start is kind of the way to think about running a campaign on Wefunder and who's going to participate. So one of the more important statistics is that about 70% of the total investment volume that happens for our average campaign is coming from the community of the company which is raising money. So these are folks that are already familiar with the business, either users or customers, people that are already involved in some sense with what the entrepreneur is trying to do. And then that last 30% is generally going to come from the Wefunder community. And so, for businesses that are looking to take advantage of regulation crowdfunding, you want to make sure that you already have a universe of users, customers, social media followers who are interested in what you're doing, because that's where the lion's share of the capital you will raise will come from.
Okay.
And so for us, the main challenge is being able to get the word out to those companies that are good companies, that have users and customers that believe in them, and letting them know that this new way of raising funds is available to them. Yep. And, once we get them on the site, then they can let their communities know and they can participate in them. And then, the Wefunder investors can go ahead and follow on in the individual opportunities that make sense.
So maybe, and the question might sound straightforward for you, but maybe for some of the person looking at this, watching this video, it's not the same as reward crowdfunding, right? It's not reward-based crowdfunding. It's equity, debt crowdfunding, correct?
Yeah. So reward crowdfunding, like you mentioned, Kickstarter, Indiegogo, you're basically allowed to donate to a company or you can pre-buy a product, but you can't actually make an investment. So you can't do something where you're going to make money on the back end, be it through interest payments on a loan or some type of exit liquidity from an equity investment. And so that's what came online for the first time on May 16th and what all of the campaigns on Wefunder are offering.
Okay, so how does one make money, by investing? Is it through an IPO, I suppose, mostly?
Yeah, so it can be in a few different scenarios, and it really depends upon the type of security that you buy. So we have one company, Beta Bionics, raised $1 million with us. They had a big VC, Eli Lilly, put in $5 million into their round at a $100 million valuation. And then let their community participate alongside this large VC at the same terms. And so they raised $1 million with us in that capacity. So there you have a med device company where you're going to make money as an equity investor, either through an IPO or an acquisition. So if they wound up getting purchased, as a company by Eli Lilly or doing an initial public offering, that's when you as an investor will get some multiple of your money back, depending upon what the valuation of that liquidity event looks like. Liquidity event being either the acquisition or the IPO. Now, another company that raised $1 million with us is called Hops and Grain. And they did something called a revenue share contract, which basically says, okay, if you give me some money today, let's say you give me $100, I'm going to pay you back $200 over the course of as many years as it takes for me to service the total amount that I raised with, I think 10% was what they chose of their top line revenue to pay back the debt. So, depending upon how fast the business grows, how high their sales numbers are, the amount of time it could take to get paid back my $200 might be 8 years, might be 6 years, might be 10 years. The idea being that, there's some type of influence that I can have on the outcome or the quality of my ROI based on how much I help the business grow. If I refer them more customers, get them more press, whatever the case may be, then I've kind of have this upside relationship with the business.
Okay, thank you. So one question, to our lecture, I have tons of questions, but so is that the concept only in the US or does it exist outside of the US?
So we have kind of similar concepts to what has been passed in the U.S. Australia has a law that works. In the U.K., they have a crowdfunding law that works. All of them are slightly different, and kind of the industries have taken different forms as a result. But yeah, the United States is by far the largest market, obviously. And so kind of I think we're going to hopefully set the precedent for how this should be done correctly here, such that the rest of the world can follow suit.
Thank you. So what are the typical investors? Because you mentioned few terms, so it's not for anybody to understand all those terms. So who are the investors, and how do you try to educate them more on understanding those?
Yes, but I think it actually is for anybody, and that's the whole point of why we built Wefunder, is that if I believe in a business, if I love the beer at Hops and Grain, or if I think type 1 diabetes is something that I want to be a part of helping improve the condition of people that live with that disease, that now I have that opportunity. So, different securities have different risk profiles, right? Like if I'm doing a revenue share or a loan to a company, the risk of losing all my money is much lower than if I make an equity investment in a startup, but also the upside, the potential to make, a lot of money, 10x the amount that I invest, is not really possible with a loan than it is with an equity investment. So we have a lot of materials on the website that will help people understand the differences between those securities, what it looks like from a risk profile, so on and so forth. I think the reality for most of our investors, and again, our median investment amount is $350. So people are not out there kind of mortgaging the house to be able to, try to beat the market with their Wefunder investments. I think, which is exactly what they should be doing. They're saying, hey, this is a company I believe in. This is a company that I want to see successful, and I want to be a part of that of that growth. And if the company winds up being successful, then, you know, hopefully I'm going to make some money. But if not, then it's not the end of the world. And so it's not the same type of calculus as people are employing when they're deciding, you know, should I put my 401k into alternative assets versus, you know, just a general index of the market. It's just a very different type of mentality that people are using when they come to Wefunder.
Yep, and so I must say the glossary that you guys have is really well done, and I think it explains really in an easy manner, even for a person non-used to those terms who will quickly grasp, you know, what are those definitions. And then maybe to get sort of an idea, you know, if you invest $250, you know, in an ideal scenario, what could be the you know, the outcome, the opportunity for one person that puts $250?
Oh, I mean, that's,
you know, like
I mean, the ideal outcome is I put $250 in and I make, you know, $2 million on the backside, right? But that's going to be a very small amount of companies that, you know, see anywhere near that type of return profile. So it really is going to be company specific. And, you know, I think that investors should really think about this like kind of a lottery ticket for the ability to invest in something that they really believe in. So, you know, if I invest in a startup and they wind up doing like what Zenefits did with us, our investors invested in Zenefits at a $9 million valuation, and they were valued at $4.5 billion just a couple of years later, right? That's one of those 100x types of outcomes, right? On a trajectory to be one of these huge businesses with that type of multiple. But I don't think that investors should come into crowdfunding kind of thinking about this exclusively as like an economic bet, right? Because these are very high risk investments. You know, if you're doing this for the reasons of trying to beat the market, it's unlikely that you're going to, right? Like most investors don't, unless you're doing it in an industry for which you are like a power user, that you feel like you have some type of insight into what's going to work. If you've used a product and you really believe that this solves your problem better than anything else, you know, then great. Of course you want to invest in that company, and, you know, you hopefully have a little bit better of a view of what's going to work in that industry than some, you know, professional investor that may not actually use the product.
Yep, and for those insights, you have the clubs, right? That's the clubs that helps, you know, group some experts. And how does this work? How does the club work?
Yeah, so clubs and scouts are just two different mechanisms that we have to try to get, you know, more high quality companies on Wefunder for our investors to be able to invest in. So both kind of work a little bit differently. Clubs are primarily used in our 506 business, which is different from our regulation crowdfunding business. But the goal of each of them is to say, hey, here's someone or a group of people that, you know, have some type of insight into a particular industry or type of business. And they're out there going out and getting those businesses up to come with some Wefunder.
And then they make investment decisions, right? As a group.
Yeah. So yes, everyone has to make their individual investment decision on Wefunder. So you have to decide. You can't invest into a fund and then just have that money get deployed automatically for regulation crowdfunding.
Okay.
But the idea is, if there are a group of people that have a certain expertise and they're all kind of like chatting collectively about what businesses they like, then when a certain percentage of them say they like a business and they invest their own money, then you'll be able to see that and then make a more educated decision about whether or not you want to follow on behind them.
Excellent. That's very, very cool. And what about the scouts? What's the squad?
Yep.
Is it like a mentor or?
Nope. Scouts are just kind of similar to clubs, except they're individuals, right? So someone has a lot of connections or a lot of insight into a particular, you know, industry, and they know types of companies which are good. They want to bring them to Wefunder and get them out in front of the community. It's a program we have to pay people for referrals for good companies that come in on Wefunder. And so that's much more on the kind of sourcing side. It's just another way that we've come up with to try to make sure that we're exploring every avenue to try to make sure that we get the best investment opportunities for our investors. And that's how the scouts work.
And I'm guessing you also have accredited investors that invest on Wefunder, right? Was it?
Yes. So we ran the business for 3 years, only serving accredited investors. So yeah, okay. We have a number of those on Wefunder.
So the WeFund, that's basically the WeFund is to, what's the WeFund? No. Try to
yeah. So 40506 deals, which is a little bit less relevant for our business right now, since we're primarily focused on regulation crowdfunding. Basically, investors invest into an LLC that then invests into the company, and the Wefunder is the name of that LLC. It's something called a special purpose vehicle. It's not really. This is like getting pretty in the weeds in terms of just functionally how it all works. But the idea is that there's one entity that holds all the smaller investors, which makes startups more comfortable with accepting a lot of investors that they don't know. And it's just a structural innovation to help get, again, better and better companies using the online investment process.
And so the entrepreneur has choices, right? In terms of funding, he can go to a bank. Well, we know how that works. He can go to a private equity. He can go through regular crowdfunding. He can go through now the regulation crowdfunding. What would be a strategy? Is it a good place to start with, Wefunder and then obtain bigger round of funding? At what stage is it a good idea to go there?
I think that we've had companies come in at a variety of different stages. The important criteria is that you have a large enough audience of people that are already familiar with what you're doing, that are excited about what you're building, that you think you're going to be able to raise, whatever your target amount of funds is. Somewhere between $75,000 to $1 million is generally what we recommend. And if that's the case, then I think that, any company that has some type of consumer-facing products will want to do this. And it's for a few reasons. One, you're able to get similar terms, if not better terms, than you're going to get from a bank or a VC from your community, because they believe in what you're doing and you're able to reward them with kind of experiential perks. So, for instance, for the Hops and Grain Brewery that I mentioned, we raised $1 million for. If you put $10,000 into that deal, then you got, a private tour of the new brewery by the CEO for you and 10 of your friends, and, some drinks on the house, right? So you're not only getting what appears to be a decent investment security that you're buying, you're also getting this experience that you're able to take part in with your friends for a beer that you love. And so there's this exciting kind of experiential component. And that becomes, I think, one of the more valuable things about doing an offering like this is that you now have several hundred, 500, maybe 1,000 people that think about themselves like investors. They feel like they're behind the curtain. They want to succeed and have an economic incentive to help you be successful. And so from a marketing and branding perspective, I don't think there are many things that you could do as high quality as this. So it works for companies of all stages, new ventures getting off the ground, companies at the stage of beta bionics that have already raised, millions of dollars from VCs. It just depends on the size of the audience they've built to make sure they can be successful.
Nice. And so one thing I've always, noticed when I go on crowdfunding sites, various ones, some do it, others don't. There's great products, there's great ideas, and you want to buy them. And sometimes it's a little hectic, to find a cool product and then and buy it from one of those sites. Is that something you guys are thinking of, or sort of?
Well, generally you can't buy the product, right? Which is why they're doing a crowdfunding campaign, because the product hasn't launched yet. So you're doing a pre-sale. For us, I think, that'll be something which is interesting. And we're talking to a bunch of folks like Amazon Launchpad and some others to be able to highlight the products of the companies that are raising funds with us. But it's not something we're going to be doing in the short term. Though I do think that's a great idea for us to have in the longer term.
Because soon you're going to have a lot of startups which will have launched, right? So then it can become
almost all of our companies have launched, which is distinct from Kickstarter or Indiegogo, where it's the opposite, right? The vast majority have not, and that's why they're doing a pre-sale campaign.
Yep, and they don't do regulation crowdfunding, do they?
That's correct.
Yep. So is there any projects, particular projects that are more inclined for crowdfunding than others?
Just like I mentioned, if you're consumer facing, if you have an audience of people that really like what you're doing, those are going to be the companies that make the most sense. A B2B logistics company probably isn't going to be a great fit for regulation crowdfunding. So those are going to be the keys.
Thanks. So the next question here is, does regulation crowdfunding disrupt or complement traditional investing, meaning private equity, banks, and what are your thoughts, on those different investment solutions?
Yeah, it's a good question. So I think what we're going to see evolve over the course of the next 5 years is really kind of more and more of a shift towards value when it comes to sourcing capital by entrepreneurs, right? So it used to be that you had the VC money was very consolidated into just a small handful of firms, and as an entrepreneur, you just needed to get capital in the door to be able to get to the next stage. And so basically, someone that would give you money, generally, you would just say yes to. The kind of shift of power has dramatically moved in the direction of the entrepreneur over the course of the past several years. You have angels coming in, which can provide a bunch of investments in the early days. More banks are willing to lend to companies without a significant track record of sales that you might have seen previously. Maybe not at the best terms, but you have a higher suite of options as an entrepreneur. And I think that what's going to be more and more clear is that the crowd is a great place to go for a segment of your fundraising. And so for the businesses that I described previously that are consumer facing, that have a large audience, I think that, a piece of their financing will always make sense to do through a site like Wefunder, because you get all this, marketing value in addition to the actual capital. And that capital will oftentimes come in at better terms than you might get from a bank, because you can provide these extra things that your users and customers are really going to appreciate because they, are already fans of what you're doing. But there's always going to be a place for, an Andreessen Horowitz or Sequoia Capital on the VC side, which is providing a very unique set of value with their relationships and, internal expertise and so on and so forth. So I think the answer is it's very complementary to other high value add forms of financing and very disruptive to fundraising sources, which are just cash. And that's the only value that they're adding.
Yep. So the next question here. So you've invested in about 15 companies on Wefunder. What's the process you recommend one to go through to select the right, company to invest in?
Yeah, I think the right process as an investor is just to say what excites you. If you see a business which is solving a problem that you have or that you are familiar with, and that's something that you want to help get to the next stage, and that's the first criteria that I would employ in terms of making an investment. And then you want to go through and see, how big is the market? Do you believe in the strategy that the entrepreneur is employing? Have you been able to use the product that they're already launched? And do you believe that they have those kind of, product development, implementation, execution skills? And then make your decisions based on that data.
Thanks. And one thing, maybe to circulate back with the prior question, I find it's interesting for private equity to know that a company already won, a crowdfunding campaign. It sort of proves, there's some traction. So I kind of, sometimes hear people recommend even for certain type of startups to first start with the crowdfunding. So it proves the concept. And then, you can go back to private equity and say, hey, we've raised, so much capital and customers believe in us. So it sort of put the private equity person in comfort, more comfortable. Would you agree with this?
Yeah, I think it's a great data point if you're able to run a successful campaign for sure.
So have you seen projects that are actually great ideas, not getting as much traction? So I'm pretty sure there's like a lot of great ideas out there, but no one funds them, so on Wefunder.
Yeah.
So how
I do think that, the important distinction, I think this runs through everything we've spoken about today, is that Wefunder oftentimes is not going to be the best place for just ideas, right? The people that are successful on Wefunder, the companies that are successful, have a following already of customers or users or people that are interested in being a part of what they're doing and supporting their growth. So you need to have that audience built up beforehand. Like theoretically, you could have the best idea in the world, but if no one's ever heard of you and you can't get in front of people that are interested in it, then you're going to have a hard time raising money through regulation crowdfunding. So the key is always going to be making sure that you have distribution and a way to get in front of people that like what you're doing.
Okay, then let's move to the market overview now. What is in your eyes, what is the evolution of crowdfunding? Where do you think it's going? How is it even going to impact how traditional business do business? are big corporations going to use crowdfunding type methodology, and they probably already are today to source ideas? And so what's the evolution, and how will it impact sort of how we do things today and tomorrow?
Yeah, again, I think that it is definitely going to be more and more a part of how any consumer-facing company does their financing, so on and so forth. If corporations wind up wanting to do this for subsidiaries, maybe I think that could make sense if they're launching kind of like new products. But it's just going to be, I think, the way that we think about how financing for any consumer-facing company works is that, hey, we want to have our customers and our users be a piece of this, and this is the best way to make it happen.
Exactly, and I love that concept, and I do believe that for corporation, it's a big opportunity too, because you involve the customer. He's at the center of the design of the product, or he provides feedback. He loves the product, and carries the product within his community. So I think for big businesses also, it's a big source of inspiration what you guys are doing.
Yep, sounds good.
So we'll close the interview there. That was the final question. But do you have any advice for people watching or reading the Start Innovation blog before we end, or anything message you want to pass?
Yeah, I just think that, same thing we've been saying the whole interview, is that there's all these really attractive marketing and branding benefits from doing crowd investing, regulation crowdfunding. But you want to make sure you have the audience built to be able to be successful before you kind of put the time into running one of these campaigns.
Thanks, Mike. Thanks a lot for all those insights. And
okay, thank you.
I'm very excited to have you in this interview. So I'll be posting it soon and send it to you also and the rest of the community here. Thank you very much.
Sounds good. Great to be here. Thank you.
Good luck. Good luck. Thanks.